Welcome to Market Thinkers, Mark Barker from GQG.
Thank you very much. Good to meet you, Drew.
I remember sitting in lockdown in 2020, I think the end of 2020, and I stumbled across this award that GQG had received as the undiscovered manager. But at the time you had about, I think, US 60 billion under management. Could you walk us through some of the history and founding of GQG?
Yeah, sure. It's been an extraordinary journey. So the business was set up in June of 2016. So we've literally just been through our 7th birthday. As we went through the 7th birthday, we hit 100 billion US. 156 billion of your dollars.
Falling dollar keeps helping, doesn't it?
The business was founded with the intention of creating a truly best-in-class, from initiation, institutional asset manager, and with a truly global footprint, and investing in global equities and subsets of global. And we were founded on some very important key principles. I think the most significant one of which was we wanted to be the most investor-aligned boutique out there. What does that mean? First of all, it means skin in the game. The business was founded by Rajiv Jain and Tim Carver, both of whom made a commitment to have the majority of their entire net worth invested alongside our clients. As a firm, and particularly as a senior management group and investment team, we're kind of all in. I have the majority of my investable assets, the large majority, invested in what we do. And you would be hard pressed to find an employee within the firm to talk to who isn't invested, alongside our clients. And I think that it's very important that everyone feels that they're a part of that. But client alignment goes beyond that. We don't allow any personal trading. We have tried to keep our fees at or below the median, for every market that we're in. And we focus on one really important factor, and that's what we call kick-ass performance. And at the same time, trying to outperform the markets, over the full cycle, and to do so with less risk than the market's offering, and it's built around a philosophy of forward-looking quality.
Is this where the name GQG comes in as well?
So GQG, it comes from the principle of global quality growth. And it's so global, not just about global equities, but a global business. Quality, not just about quality as a style, but a quality of delivery. So we want to have best-in-class client service, a really solid sort of institutional infrastructure, and high-quality returns. And then growth, again, growth is not about a style. Although we do favor companies where their earnings are growing, but it's about the compound growth that we want to deliver to our clients.
And Rajiv Jain's quite well known, so your CIO and founder is quite well known globally, but probably less so in Australia. Could you expand on the kind of his background before GQG?
Yeah, so look, for a long time, Rajiv was at Vontobel Asset Management prior to joining. So he joined Vontobel in the early 90s, and as PM on the Emerging Markets Fund there, and this was a business that was just over $300 million at the time. Rajiv ran EM, he ran global, he ran international from a US perspective, i.e. global ex-US, and a number of other portfolios, all with the same philosophy and process and around this idea of forward-looking quality. And he built that into a $52 billion powerhouse by the time he left at the beginning of 2016. Had an extraordinary track record, and is I think recognized as one of the great long-only equity investors. And it's a privilege for us to be working alongside him.
I've heard some interesting stories about how he built his team originally. How's that team evolved in terms of analysts, portfolio managers, and how many strategies do you run?
So we run 4 strategies in total. So we have global, which is a truly global product. As I said, international from a US perspective, i.e. global ex-US. We have emerging markets, and we have US equity. We also have, and these are our sort of what we call our quality growth funds. We run within those 3 strategies, but within 3 of those 4, so not including emerging markets, we also run a quality income dividend strategy, which is clearly more income focused. Now, in Australia, our offering is limited to global and emerging markets, and therefore the global for the quality income.
We hear from a lot of global equity managers in Australia that it's great to be away from the noise. Is the head office still is based in Fort Lauderdale? Is that a deliberate strategy, or is it weather-based potentially?
Well, yeah, weather can be as much of a challenge in Fort Lauderdale as it as a bonus. I think being away from the noise is important, but to be fair, we actually have a very significant office in New York as well today. So the investment team is sort of split and moves between those 2 offices.
And you're based in Europe?
I'm based in London, yeah. So I run our international business, sort of including Australia from London,
yeah.
Which is great from a time zone perspective.
And it'd be good to understand for our clients the construction of the portfolio. You talk a lot about forward-looking quality, and how you go about that. So your universe, very big, universe of potential investments to go in there, and then how many investments would generally be in there at any given time?
Yeah. So firstly, I think that there are a lot of managers out there who say they'll never own a certain type of business. Or they'll always own a certain type of business. We are much more agnostic than that. We think that quality can be found in every industry vertical, and but not at all times, and certainly not at a price that you may find attractive at all times. But I think the most important factor for us is one of liquidity. Look, humility, I think, is a key aspect of a successful portfolio manager. There has to be a recognition that for every decision that you make, there's every chance you're wrong. And there's nothing worse than being, long, wrong, and illiquid. So we want to be able to get out of the way. Now, what that means is that we're always going to be operating in sort of the large and mega cap space. You'll never see us going down into the small cap world. And so that's about the only never that we have. But in our global portfolio, typically sort of 40 to 45 names, sometimes a little bit more. And it's interesting that the portfolio tends to become more diversified as the opportunity set widens.
Yep.
Some investors look at diversification. You become more diversified when you're worried about the world. We actually think that when you're worried about the world, you want to really focus on the things that you really know and understand, and you don't want to take any risk outside of that. So that's where the portfolio may become more concentrated. In emerging markets, the number's higher, sort of more in the sort of 60, 65 name type realm.
We've seen a lot of growth in passive investing, whereas your strategy, which we've seen in the last year or 2, is you've got a willingness to kind of swing, whether it's sector exposures or company exposures. Is that's driven by quality and changing valuations?
Yeah, look, I think
there's a lot of index hugging in the industry.
It is all the result of bottom-up work. Fundamentals for businesses can change over time. We felt as we came out of the pandemic that the fundamentals were beginning to break down in the tech space, and valuations were stretched. And that's a fairly unattractive combination.
You were quite contrarian on that position at the time.
We were early, yeah.
Right.
And in hindsight, we were right.
Yeah, you can be contrarian and right.
But look, you don't always need to be contrarian. I mean, most of the time the market is right. There's nothing wrong with being consensual. if you're being paid to be consensual. But at times the market can be very, very wrong. And that was one of those. And I think it's, as particularly at the end of a long part of the cycle. And I mean, I don't think there were many people out there that didn't recognize that we were in a bubble. And we sort of knew it. And now it's driven by FOMO. It's when do I get off? And I think that's hard. Navigating that is messy. But this is typically when we will underperform. So, our performance suffered through the latter part of 21 because we had got out of that very frothy sort of valuation agnostic market, and we're really focused on where we could find the highest quality at more attractive prices. And that was, particularly in the energy and materials side. But all of this was a function of bottom-up work that we were doing, and opportunities do cluster. So you can, when you talk about those big sectoral or industry swings, it's generally because as you're doing work on a name, and you start looking at the peer group, you start looking at other parts of the value chain, and you realize that there is a general clustering of opportunities. So those top-down shifts are the output of the bottom-up work that we're doing, rather than a sort of a top-down decision, this is where we're going.
We have this really basic saying, we have the golden rules that we use to manage money internally, obviously Wattle Partners being golden. And one of them is I plus G equals total return. So when we look at portfolios and objectives, income is an important part, but growth is equally important for people in retirement.
Yep.
Is that growth opportunity still there in global equities?
Oh yeah, for sure. Look, I think the great thing is that there is a big universe of names out there. If you want to own 40, 45 names, out of the thousands of companies worldwide, you should be able to find businesses that are growing and can sustain that growth. If you can't, we really are in a bad place. But as we saw that sort of tumultuous collapse in earnings in the IT sector, which was really just a function of a reversion to mean after the pull forward effect on profits through the pandemic. Everyone had been buying more shiny kit in a shorter space of time through 2020. So they obviously weren't going to be buying as much as we came out again, because it was still relatively shiny. But at the same time, we were looking at the energy companies and within these businesses, because they had been constrained of capital, in large part because of the ESG agenda for previous years, they had become much better stewards of their own balance sheet, had become much more disciplined with regards to their sort of capex and opex. KPIs for management had changed from being focused on production growth to being focused on improving margins and profitability, and even some concept that I don't think anyone had ever really talked about with regards to energy companies, free cash flow. But you could look at a name, going back then, sort of like an Exxon, and we could see a sort of a doubling of earnings over 5 years on a pretty conservative base case around oil, just because of their sort of reducing their lifting costs over time. So these had become very high quality businesses, so pretty much unnoticed.
Almost by accident,
Yeah.
You've kind of consistently generated alpha over the last 5, 6, 7 years in a period that most haven't, though. Like if you go through, I think Spiva will still show you something like 87% of active global equity managers can't or haven't outperformed. But you're still investing in the mega caps and the large caps. So where is that edge? Is that the bottom up edge, the analytical edge? Where is the edge that helps you to kind of keep sustaining that?
Look, I think it's about being adaptable. It's about not being dogmatic. Managers talk about discipline, but sometimes what they do is they translate that into rigidity. I think that there is unfortunately for investors, there's this sort of overly dogmatic focus on style. I'm a value investor, I'm a growth investor, I do this, and I'm going to limit myself to, certain segments of the market. And now, for commercial reasons, I can't move away from that because I've said that this is what I'm going to do. So if the environment changes, then, well, I'm kind of a bit stuck. We, on the other hand, we are very focused on adapting to a changing environment. But I think ultimately what underpins our alpha is, firstly, a focus on managing the downside. Yeah, we don't expect to beat a ripping bull market. We don't expect to beat a frothy valuation agnostic market. And we would be surprised when we do, and we have on occasions, but we're very surprised by that. And we have traditionally outperformed in more challenging environments, and over time our sort of downside capture is sort of 65-70%, whereas our upside capture is sort of 85 to 95%, and it's that spread that drives that alpha. But what really drives that, I think, is a process that is built around sort of intellectual honesty and challenge within the team, to try and look at our businesses from as many different perspectives as you can, and to have an emotional detachment from the decision that you made yesterday. Most PMs are pretty good at buying stuff. Most are pretty poor when it comes to selling stuff. I think we're ruthless sellers of stock. We're very good at, we have been very good. I have to be careful from a compliance point of view. We have been very good at getting, out of the way
knowing when
as the data starts to break down.
So as part of our model portfolios, we essentially try to gain outperformance for clients via finding different sectors or different parts of the economy or the global economy that are performing well. One of those is emerging markets. So we see significant value there. Could you walk us through your process and how you leverage your developed market or US experience with what's going on in the likes of India and China?
Yeah, absolutely. And look, I think it's very important, and I do believe that this is part of our competitive edge. We are a one philosophy, one process, one team approach to everything that we do. So all of our investment team are generalists, both sectorally and regionally. And look, we live in a very joined up world today. There is an interplay between EM and DM. They're in effect an artificial construct. And so if by having a foot in both camps, I think you have a better understanding of the world. And I think we have built the team to have as many sort of cultural and professional backgrounds as we can to help us make better decisions. And I mean, if you had 4 guys from Connecticut out of Harvard talking about the US-China trade wars, they're going to have a pretty consensual view between them. We've got, people from mainland China within the team. We have people from Latin America. We have people from the Indian subcontinent. We have people from the Middle East in the team. And I think, they come together and help you build a more balanced perspective, and sort of better judgment calls. But, we're always thinking about the interplay. And I don't think it's any great secret that the developed world is struggling today. And it's interesting that, many of the emerging markets in recent years have sort of discovered fiscal rectitude at a time that there is an abandonment of any sense of that in the developed world. We have, I think, pretty much across the major developed economies, a little bit of a demographic time bomb taking place. The bulge bracket is getting older. I mean, in the US today, right now, there are 10,000 people turn 65 every day. That's a pretty scary number. It's very attractive for us as investors in healthcare, but from an economic perspective, it's a little more worrying. The median age in India right now is 28, and you have an improving fiscal balance sheet in India. You have expanding credit. You have this very young population, and I think it creates a secular opportunity that is going to allow a number of businesses to really flourish. Interestingly, China has more of a demographic problem, sort of akin to the West than other emerging markets. But I think we keep EM as an important component of our global equity offering, and it will sort of ebb and flow as not only the opportunity set in EM plays out, but also the opportunity set within our DM names. But these are very important parts of the process.
And that's one of the big reasons we stress to all of our clients that you need to look overseas. Like, you can't just be looking solely at Australia, because there's different economies growing at different rates with different levels of economic support. So maybe a last one to bring it back in is, there's a unique Australian connection for GQG.
Yeah, absolutely. I mean, in a couple of ways, actually. So, our first institutional client back in, for the shortly after the firm's founding in 2016 is one of the super funds down here, which was, our first significant mandate into emerging markets. So, Australia is a very important part for the business. We IPO'd GQG on the ASX in 2021, we have built out a really quite a significant business here, and it's one of our fastest growing parts of the business today. I think both the super funds and the sort of the advisory business industry here are very sophisticated. I think investors are well advised, and we've found that it's a great place to do business. I love coming down here.
We've maybe not in winter. We've found you being one of the more.
You haven't seen my winter.
Fair enough. We found you being one of the more progressive managers in terms of communication, in terms of competitive pricing and all those sort of things. So, Mark Barker, thank you.
Thank you very much indeed.